In the last video, I was discussing the non-QM loans that we offer and really detailed information on the DSCR loan. Now I'm going to be discussing the difference between the FHA and the conventional loan, because that is the most common loan product that we use here. They're called QM loans, right? Qualified mortgage, not a non-qualified mortgage. The FHA loan is something tailored to someone that has a little bit more challenged credit. Okay. For someone with conventional loan, rule of thumb, I always say, if you have anything above 680, ideally 720 plus, we would always suggest the conventional loan for many reasons. First being that if you put more than 20% down, right? So you have at least 20% of equity in the property, you won't have PMI, private mortgage insurance, okay? With FHA, the only way not to have mortgage insurance on it is not PMI, just mortgage insurance, is if you put 11% down and in 10 years it will come off, which in most cases, why would you put 11% down on an FHA home? Also, you're gonna be refinancing that property more than likely in the next 10 years anyways, right? Or you're going to refinance it into a conventional loan, right, to get off that mortgage insurance. With an FHA property as well, if you're financing a home going FHA, there is an upfront mortgage insurance payment that you have to pay as well. You could either finance it into the property, which most people do, or you could pay it upfront, okay? The rates between both conventional loans are going to be slightly higher than FHA loans, because with an FHA loan, the lender is not just qualifying you on if you could repay back the mortgage, right? And you could afford the monthly payments. They're actually qualifying the house that you're purchasing as well. So some of the key things they look at for an FHA is the appraisals are a little different. They're going to be focusing on the foundation of the home. So if the home that you're looking to purchase going FHA has major foundation issues, right, roof or floors, anything like that, they're going to avoid and say, hey, this home does not qualify for an FHA loan. For example, I had a client who we're going to close, I would say, in the next 2 weeks. We got back the appraisal, and in the appraiser put on the report that one of the locks for the windows were broken. The lender reached back out to us and said, hey, we cannot close this loan. Mind you, we were clear to close, right? We had all the conditions cleared, but they're just waiting for the appraisal because it took longer than expected. But just because of that lock supposedly being broken, we couldn't close. They would not give us the CTC, they cleared to close. Come to find out, I had the realtor, the buyer's agent, go back to the property and check it out, and the lock wasn't broken. There was just a little bit dirt on the lock that didn't allow the appraiser to actually lock the lock itself. So we had that cleared. The appraiser came back out. He saw it. He fixed the report, and then we were able to close on the property. But again, FHA loans, they're that tedious on certain things, right? Even that small. So be careful. So with this scenario, you see my test file here. I'm gonna go through a quick scenario with an FHA because you can see it firsthand, right? So let's say that a client is looking for a property that's $400,000. All right, we're gonna automatically assume that it appraises for 400 as well. The minimum down payment for an FHA loan is 3.5%, right? 3.5% of 400,000 is 14 grand. Perfect. I'm gonna save the changes. Keep in mind, you can see it right here. This is the upfront mortgage insurance payment or premium, $67.55. Okay, it's saying, do you want to finance it or not finance? Again, more than likely, people are going to put that into the loan amount. So instead of financing $38.60 or $38.6, they're going to be financing $392,000, right? $755 in total, right? So the loan amount is going to increase by this. And then we're going to look at the mortgage payment. These things you don't necessarily need to worry about, but there are factors or different factors when it comes to what your mortgage payment is going to be. Aside from the price of the home and the interest, which unfortunately most people fixate on, those things, well, the interest rate could change. Price of the home can't change. You could always refinance into a lower rate. But the things that are going to constantly go up, right, especially here in the state of Florida, is your homeowner's insurance and your property taxes. And if you have an HOA, the HOA more than likely is going to go up as well. Okay? So, homeowner's insurance, $200 a month, right? That's $2,400 in a year. And that's what we've been seeing more or less, right? Again, cost of insurance has been increasing, depending on where the home is located, right? If it's next to the coast, you're going to see higher insurance. Plus, flood coverage, you're going to have to pay as well. But that's on a different video. Property taxes, rule of thumb, I'm very conservative when it comes to numbers. So you can see here it's at 1.4%. It probably won't be $466 a month for insurance for a property at $400,000. But again, I like to be conservative with my clients. So when they actually get the numbers, they could drop it down a little bit more. Right, it's not a payment shock. Next, you have your mortgage insurance here. You see, it's originally 0.55% or 0.5% of the purchase price, $176 a month. And then we have the association dues, which is your HOA. In this scenario, we have $100. And people, keep in mind, I've seen HOAs from 4 or 5, even Miami has it at $1,000, $1,200 a month, which is ridiculous. And keep in mind, they can increase it whenever they want. If they don't budget their monies right? If they decide to change all the roofs in every property, or if they decide to put a new community center and put a new gym or fix the pool, that's coming from you guys, right? The HOA, the people that are paying towards the HOA, they're going to be paying. So keep that in mind. Again, very brief video. I really focus on the FHA side. But if a client has anywhere, again, 620, we're going FHA more than likely, right? You're going to have more favorable rates. Again, it's going to be a little tedious on the property, but you either increase your credit score, right, or go FHA. In this case, right, we'll say in the next 3 to 4 years, let's finance into a conventional loan. When you build enough equity in the property, if the value increases, right, and obviously paying down the loan, the equity is the difference between the two, and it's going to keep increasing. In the meantime as well, you're going to be increasing your credit, hopefully. Right? Hopefully your credit goes up. Hopefully you get a higher paying job. And again, we could refinance to conventional. If you guys have any questions on these types of loans, let me know. I appreciate it. Thanks.